Welcome to the first episode of this podcast, Sweatin Money. I'm your host, Kong, along with my co-host, Gibson. Why don't you introduce yourself there?
Thanks
Gibson?
for that introduction. I don't think I can improve upon that.
Yeah.
I don't think. Kong actually helped me figure out my handle here, so very appreciative of it.
Yep. You're welcome.
Yep. It's a kind of an inside joke thing, so I'm not sure a lot of you will get it, but
Yeah, they don't need to know about that.
they don't need to know.
Yeah, we'll tell them about it later.
All right.
So, what this podcast is about is just two guys who don't really know much about investing. So far, we're just kind of like just gambling with, gambling with our money. So,
Although I do have a slight advantage, given the fact I have a economics degree from UCLA, but just a tiny little bit.
So what we're doing is we are testing out our theories as to who has the better investment strategy, or gambling strategy, if you may. So caveat emptor, we are not professional.
Do not sue us.
Yeah, don't sue us because we're not professionals. Don't take our word as if it's like, as if we're like Warren Buffett. We're not sages here. And you may lose your money. So we've put out that caveat. Don't listen to us. There you go. Done.
But we make very valid points.
Okay. So, Gibson, how are your stocks doing?
Actually, my stocks are doing pretty well, I think. There's just no way that you can predict the market perfectly. But I think, the question is what is investing and what is gambling. So you just understand that, you understand the risks, you understand, the difference between the two. So all in all, we can go into that bit later, but all in all, I think my stocks are doing decently well. In a market that is tanking, when you're not in play, you're actually making money, cause then everyone else is losing money, but your money basically stay flat. So I exited the market before the market dipped today. So in a way, I did pretty well today as well.
So for someone like me who actually just didn't do anything with my investments, all I did was just keep it in well, first of all, let me just clarify. So I have a set of stocks that are in a tax deferred account, retirement account of the sorts, and then I have a set of stocks that I own directly, and I haven't done anything with it. So I'm just letting it sit there. If it gives me some dividends, and that's great. If it doesn't, whatever. Actually, if my dividend paying stock stops giving me dividends, that's usually a bad sign. So I'll probably sell that soon.
Yeah, you definitely should. The question is, should you just keep holding on to it? And I see no reason to hold on to that stock, because you understand that a stock is like a product you buy and sell. And behind every single product, there's a specific consumer type that contribute to its value. So if, those consumers that bought your stock were dividend investors and suddenly the dividends just stop coming, they really have no reason to hold on to that stock. So
yeah, exactly. And I think one thing to differentiate between what I'm doing and what you're doing is, you're going all out with options. And that's a whole nother beast. And what I'm doing is I'm more conservative in what I'm investing in. And so I'm just going for big corporations with a large presence all over the world. And I'm gambling on the fact that these guys aren't going to go away anytime soon. And they're going to be there. And I want to make money off of the fact that they're giving me dividends. They're making money off of me in that I'm giving them money so that they can play with. In exchange, I'm getting their stocks and I'm getting their dividends. So
yeah, I would say that I'm not doing purely just options, but options are good to be aware of because options give you, options. So, yeah, but certain things you have to understand that options come with a concept of premiums. So the premium is basically, what is an option? An option is a contract that allows you to buy or sell a stock at a specific price. So the person, there needs to be a person that writes the contract to say, hey, you know what? I will sell you these options to buy this stock at a certain price before a certain expiration date. And then basically by you not exercising an option is how they kind of make their money. Or, basically you sell the option back at a certain price and, they buy it back cheaper. There's many different ways to make money on the option itself. Just the option. And of course, why do people buy options? Is that, options allow you to basically gain access to all the gains and losses of a stock as you held the stock while actually holding the stock. So for example, I can control a $50 stock with a $10 option. I could basically have the rights to buy and sell that stock. So let's say like that $50 stock basically becomes a $100 stock. Well, now I have a $10 option to buy that $50 stock at $50. It went up to $100. So now, even if I were to sell the option at $40, it'd be really cheap because that's a $30 difference, and it gives me the rights to buy a $100 stock at $50. So then the person who just exercise my option makes $20 just by exercising an option. So that's kind of how options kind of work. They give you the ability to gain access to the gain and losses, but at the same time is that if it weren't for the options, you wouldn't have had access to those gains. At the same time, the option will expose you to the loss. And it's not very apparent that you'd be exposed to loss because you just think of it as like an option you may or may not exercise. But you have to understand that this money is money you wouldn't have lost if you weren't for the options. So options kind of have a multiplication effect. So it multiplies your gains and also multiplies your losses. That being said, options also have a built-in stop loss. So let's say I have an option, I bought options of intrinsic value of a total of $100. I can only lose $100 intrinsic value. But at the same time is that movements in the stock market is generally so minimal that you wouldn't have lost that much money in the first place. For example, let's say I bought Bank of America or, let's say Bank of America. You know, the movement of the stock may be like 1%. Let's say I spent like $100 on that stock. I would have lost $1 in that day. Like that's, you know, at the current price, I think it's like, let's say it's $20, you know, I bought $100, I bought 5 stocks. That's not a big loss. But let's say I use $100 options, and an option contract, you have to buy 100 shares. You multiply by 100 shares. So let's say I had, $1 option, the contract is at $1 for the options. That means I need to spend $100 to buy $100 shares. One option contract is 100 shares of Bank of America, which means I have to spend $100. Now, if that Bank of America prices change by even like 1%, I have a much more significant impact on me because I have the impact of 100 shares moving in a certain direction. So this definitely, I'm not sure if I'm explaining it as well, but
so basically, like, what you win, you win big, but if you lose, you also lose big, pretty much.
Well, it has a built-in multiplication effect. So, yeah, you can win and lose big. The question is like, if you're absolutely sure of your bet, like that's really the only thing an investor can be is that be sure that relatively confident that that's the bet that they want to make. Ultimately, when you buy a stock, I wouldn't say that you should buy a stock thinking, oh my God, I want to make money per se. Is that more so like you're voting with your money going, oh my God, like this is the company I really want to support. Like I want to lend them money. I like what they're doing with the money. I like what their company mantra and motto is. I just want them to take my money and then be more successful oftentimes. Yeah,
but I mean, that someone goes against what Warren Buffett does with his money. I mean, he says, you don't go with what you're familiar with. You go with basically what will make you money. So for instance, like let's say people that are buying into Tesla right now, like you've been saying, you know, Tesla hasn't really been making a whole lot of money.
I don't understand Tesla.
Yeah, but I mean, but people are still just handing them money left and right, just buying into their stock. Exactly. Yeah. So I mean, in that case, yeah, I mean that's exactly what people are doing. But then I don't know if Warren Buffett's the type of guy that's actually going to invest in a company like Tesla.
I'm not too sure if he would, but I would say that Warren Buffett has been known to say a lot of things. And one of the things he does say is kind of like he makes examples, like he will say a lot of examples where he would be like, oh, he would take a look at like this business and he'd take a look at McDonald's or Pizza Hut and he would just take a look at how many people go in. And then he would just to check this to get an idea, a sense of whether or not the company's doing well. He just looks out the window and go, oh, there's a lot of people there. I guess they're doing well. So he does talk about invest in things you're familiar with as well. Of course, I don't know if he said things to contradict it. It's possible. I mean, people flip flop on opinion points all the time.
Yeah, that's true.
Yeah. Although Tesla, I definitely do understand this company because it's bleeding money every single year. But if you were to account for the people who simply believe in the vision of Tesla, in the vision of having electric cars that are capable of competing against non-electric cars or like gasoline cars, etc., and a lot of people just investing in it, then it does start making a lot more sense. Like, why do you keep throwing money at a business that keep bleeding millions of dollars a year, every year, without any sign that they're stopping the bleeding or anything, unless you just believe in what they're trying to do. You want them to have a lot of electric cars on the road. You want them to have a lot of super batteries. You want to someday hopefully move our nation, the world, into a more ecologically friendly state.
Or, I mean, is it possible that there's something there that we are not that we haven't found, that investors are saying? I mean, aside from personal beliefs, that investors are saying they're looking at Tesla and they're saying that's actually a solid company. Yes, they're bleeding money out of the ass, but I will invest in it. I mean, aside from is it possible that we may not have noticed something?
I think I have a discussion with a friend, and we talked about variable change and the Monty Hall paradox. And basically, it's when new information is introduced, your original projection and prediction might not be correct. And financial analysts change their price targets all the time. It's pretty normal. It's pretty expected because additional information gets presented. And I would say that a lot of people might have been pushing for electric car because they're thinking gas prices were just going so high that eventually we just fueling up your car would not make sense with gasoline, and get move from place to place would not make any sense. So I think a lot of the movement with Tesla might have been contributed to how expensive fuel is getting, and then, the next viable alternative, if gasoline stops being viable, would be electricity. So I think a lot of the movement was towards that. But given how the gas prices are moving now and the direction that the oil's market's going, I think Tesla's going to have a little bit tougher time selling their cars and selling their batteries. But that also depends on our governmental incentive, our environmental incentive, because you have to think about it, is that the more oil we have, the more carbon dioxide we're releasing into the atmosphere, and that cannot be good for global warming.
Yeah, but then, I'm not too familiar with the technology that he's going to use, but I just wonder what exactly the carbon output of the Tesla battery factory is going to be compared to, say, the Toyota Prius battery factory. Because if you look at the carbon footprint between the Toyota Prius and a Hummer 3, actually, in terms of just sheer manufacturing, the Toyota Prius actually outputs more carbon just because of the battery itself. But if you're talking about in terms of miles per gallon, how much the driver is going to get out of it, then yeah, the Toyota Prius is going to win any day as opposed to the Hummer. But overall, the Prius is still environmentally damaging.
I would say that, I think there is a cost to everything, no matter what it is. The mere existence of humans on this planet will have its effect. And I'm just not too sure, if, let's say you have a gas car on the road, would it over 10 years produce more carbon emissions than a electric car on the road? And I'm not too sure. I've never looked at a metric, but intuitively I would think that the electric car shouldn't produce as much carbon emissions. And not only that, but a gas car's fuel is gasoline. It has to come from oil, has to be refined and whatnot. But electric cars, their fuel source can be anything. It could be nuclear power, solar power, wind power, and etc. So I'm just thinking that would make sense in the long run when we become more environmentally conscious.
So, I guess, I don't have the exact math on here, but then, I guess, to really do an apples and oranges comparison, I suppose you'd have to take the carbon emissions from the Toyota Prius factory and then factor the lifetime of how long someone's going to keep their Prius. But, yeah.
I would say that, we're not exactly off topic right now regarding stocks in Tesla, is that I feel like oftentimes psychology has a lot to do with stock price movements as well. And I do not believe that typical consumer and the typical buyer of the typical participant in the stock market is this well versed in the carbon emissions and impacts. I think they just kind of have a very superficial understanding, and they go, gas prices are skyrocketing, and then Tesla might be a good buy because of electricity and electric cars. Right. So it's a lot of things, and sometimes if you're too ahead of the market, you might actually lose money. Sometimes you could be right, and you could be such a prophet that you just know the direction where the market's going, and perhaps the market hasn't caught up yet. So it depends, because I do a lot of day trading, So sometimes these micro fluctuations do impact me a lot. For example, making a lot of money and losing money could be when I was ahead of the market or behind the market. For example, let's say I predicted during the Greece crisis that the stock prices will go down, but then a lot of people had a lot of hope because they just didn't think the way I thought about the process. So the market will actually move up thanks to all the news and everything they read about, because they're thinking intuitively that things would pan out really well for the country. But at the same time, I'm thinking I would factor into play like what I believe like other nations would do and so on. And I would think that there's a lot of uncertainty and there's a high probability that things won't pan out. So I might have shorted the market while everyone was thinking the market would recover. Ultimately, for a good period of time, the market was tanking. So if I was doing a short position on the market, I would have made a lot of money. But it all depends. And just, a lot of people don't think as deep into the topic. So sometimes it does help to not be as well versed as all the experts are.
Yeah, but you're going off of basically timing the market, which is once again what a lot of people actually praise against.
Yeah, so, but at the same time, I would say that like if you do not, well, I wouldn't say I'm timing the market per se, but I am trying to understand why the market's moving on a day-to-day basis, on a like maybe hour-to-hour basis, as opposed to making a long-term projection. I also make long-term projections. I was thinking, hey, you know what? Thanks to this news, I think the market is going to move on an upward trajectory. But then on a day-to-day basis, if for example, Greece is a great example because relatively recent, is that the entire market was extremely afraid that the Greece will exit Euro. And it's not so much that the impact that one country would have against the entire world. It's more so the implications of what a Grexit, which is a Greece exit, would imply. So,
that is an exit from the EU, just to clarify.
Yeah. So, yeah, it's on like, all in all, the long macro projection is that it would be kind of suicidal for Greece. Like a lot of people who bought Greece after, like, they invest into, the entire market tanks. So any type of index, you have the European index, the euro, you could have bet the euro, you could went with the Dow, because everything was kind of interconnected. So if you're participating in the market at a time and you're doing a buy position, you're ultimately betting that, Greece impact, the Grexit impact wouldn't really affect you. So, so my read on it at the time was that at the very beginning was like, it would be suicidal for Greece to exit the euro. But then at the same time, so basically a lot of news said, oh, Greece is exiting. The market was panicking. You have to understand that, there's people do not like the prices are a reflection of supply and demand. So the prices go up when there's a lot more buying activity than there is selling activity. So when the buy perfectly meets the sell, the price is stabilized. And then there's other factors as well, like volume. Like for example, the total amount of outstanding shares. If everyone were to just sell the shares all at the same time for a certain company, it would just completely tank. But for a short period of time, there was a lot of panic. A lot of people sold their shares in the market itself. It wasn't so much like any specific company. Everyone that was investing just came to conclude that there's a lot of volatility in the market. There's a lot of risk. There's a lot of risk that they don't need to be part of right now. So they triggered a lot of selling. And then there's also a factor involved where people were hopeful and optimistic and go, oh, it's a good deal because everyone's panic selling and Greece will be fine. So there's a lot of buying.
Okay, well then to add on the whole Greece thing, I mean, aside from Greece, of course, we're also worried about China right now. One of the things that we're worried about China is, I mean, before the government had stepped in, that I think in just a couple of weeks, China had lost 30% of its value, which was like over $1 trillion lost, just gone. And so where did that money come from? Well, it was a lot of average investors who were basically all jumping on the bandwagon of stocks. It's pretty much like 1929 all over again. And then now the government was like, "Oh, hold on, we can't just let this happen." So then they didn't allow the major investors to sell off the shares. Like they had actually set limits. Because they still had to allow companies who wanted to get onto the Shanghai Stock Exchange to get listed on there. So they had to let that happen. But then of course they couldn't allow people to sell. So then it artificially kept things stabilized. But then like once those standards are met, and then after a while, like they would, like sellers are still going to like sell as much as they can. Even if the government's going to set limits, it's still going to sell. So, and like, even if they set like, oh, well, you major investors, you can only sell off like, 50 shares or something. Then even if those people are going to sell off 50 shares, the other investors, if they have 50 shares or whatever, everyone's going to sell as much as they can.
I think it's very interesting what China did. I think, if you think about it, like I said before, and I finally regained my original point, and we can follow this later. But if you think about it, is that the market consists of like buying and selling. It's a marketplace. Ultimately, it's a marketplace. There's buyers, there's sellers. Now, you have to understand that when you look at the market, when you look at a stock, if you ever notice something called the institutional percent, you'll come to understand that there is institutions, that major players that control 91% or 90, like a majority of the stock. They own a majority of the stock. Now, these institutions might not be numerous, so it might be like a handful of organizations. And if those handful of organizations sell on that day, no matter how many individual buyers there are, the entire stock market price, the entire stock price will dip. So the question is, there's an impact. Like individual investors do have a certain amount of impact, but institutional investors can have a major impact as well. So what China did was kind of interesting because they prevented major players and institutional players from acting, from having a giant effect on the market. So I just not sure what's the implications of that, because in economics, it's a form of social science. We don't really have a lab to go, oh, we're going to test this and try this. What we only have is observations. So it's government intervention at this level. I just find it quite interesting, at least because I'm not an institutional investor. And I think it's kind of comforting to know that, for example, like let's say there's a mutual fund, to protect its own investors, they might want to withdraw from the market at that given moment. They don't want to take that risk. And by them selling in the market will drop the prices down. So, I mean, and of course, there are consequences of the institution buying and selling in that quantity, that they have to be very certain that, they need to sell the stock. If not, because they will cause the stock price to trigger, and, the first batch that they sell might be fine, but the subsequent batches might, sell at lower and lower prices as there's less and less buyers who buy it. Not only that, but buyers will start questioning, why the hell is there so much supply of this stock on the market right now? And there's another thing, is that there's a buy and sell schedule. So just because you see a stock at a certain price doesn't mean that there's a lot of, you think about it, it's like buy and sell orders. So there's a certain, if you take a look at the stocks, you'll see something called like a bid and an ask. And then they'll tell you about the quantity of bids and quantity of ask. So it's a reflection of how many people are wanting to buy that stock at a certain price and how many people want to sell that stock at a certain price. So, for example, like let's say you're a big institution player, you might fulfill all the sell order, the buy requests at a certain price, and then you will have no more buys at that price. Then you have to sell at lower and lower prices in order to get your quantity sold. That effect can be like dramatic. So I think, but then again, the other question of course, is that as an institution with billions and billions, and not only that, trillions of dollars. There's institutions with trillions of dollars, like Vanguard, do they have more information than the typical consumer? And chances are they might.
Yeah, I would say they do.
Well, I don't want to say definitely, but I would not be surprised, because I haven't seen it, but I mean, with $1 trillion of assets and, a few % management fees, I'm sure they can afford to keep eyes and ears in every single corporation there is to make sure that they're abreast to insider information more so than anyone else. Of course, we would like to believe that insider trading is illegal and that no one would really do it. But I wouldn't understand the movement in the market. Like there's movements in the market when there's absolutely no news at all. It's just constant fluctuations. And I would imagine perhaps someone knows something that I didn't know of, that caused them to sell or buy in large quantities enough to affect the market. I'm
pretty sure there's something. There's a lot that we don't know about, especially since you and I don't have access to, the level 2 trading type, equipment.
Well, I actually do. I have access to level 2, But it's like I would say if you're a day trader, you would definitely need access to level 2 data. But if you're like a long-term investor, you might not need it as much.
That's true.
Yeah, I definitely do, because for me, on a day-to-day basis, I would read about, I would form my theory on what will happen to the stock price at nighttime the next day. And then I would wake up in the morning and watch the market and see if it's moving in the direction I expect it to move. And then not only that, but if it suddenly flip-flops and changes direction, I'm like, well, how aggressive is this change? Like how much of a force is moving it up and how much of a force is moving it down? And thanks to level 2 information, I can see exactly how many buy orders and the shape. I can't do the math as quick, which is the way, I guess you have to have the level 2 chart in front of you to understand how it looks like. Right. It's a bunch of bars, and you could tell the shape, like how much demand it is for a buy position, what level they're buying and what level is selling, and how much is their sell positions. And even then, if there's a single individual or an institution that has set a sell price at a certain level and they had a huge quantity, you could definitely tell in a level 2 data. Unfortunately, those who do not have level 2 data access information would not be abreast to know that there's a ceiling and there's a floor at a certain price. So level 2 helps with that.
So have you actually looked at some of the charting strategies that are out there?
Not really. I'm not sure if I fully believe in charting strategies. Yeah, like I think the movement tells you something, but like I said, like I would say I'm almost like a fundamental investor, but not quite. I would say that fundamentals come into play for the companies I choose to watch. Right. And then everything else, like I think I was watching Money. What was that show you introduced me to? The Money one.
Which one? You're not Nightly Business.
Nightly Business Report. Yeah, Nightly Business Report. So they had an interview with one of the fund managers, and what she said to me was very phenomenal. She said, "What is priced in?" So basically, what she's saying is that the price, it's a reflection of the entire sentiment, the existing fundamentals, all the news, and etc., and then all the upcoming fears and hopes. And she's like, what does that price reflect? So what's also interesting is that what she's also saying is that when those factors that compose the price of what's priced in changes, the price will probably change as well.
Right. Okay. So, you think this is good enough? You think we should end it here? I
think I did a piss poor job, and I need to redo this.
Whatever, man. This is good.
Yeah. So, right. It's a bit of a rant. I think as an initial podcast, it's gonna be kind of like this, but I think future ones will probably be more well honed.
Yeah, I think this is good. At least like we're kind of like figuring out, okay, well, what are some of the things that we can talk about? Like, how the format should be. There is no format for now, but we're basically winging it.
We're open to criticism.
There you go. But
help us help you.
Yeah, there's that. But don't be too harsh, please. I know you guys on the internet. You guys can be mean sometimes. So yeah, constructive criticism, please. That would help. Thank you. Any last words?
The most important thing, the best thing you can say to anyone in Vegas is good luck. So good luck out there, guys.
All right. Thanks for listening. Bye.
Bye.